Thanks for waiting there. All right, so let's get started. I'm gonna start sharing my screen now. And well, first we're gonna rip through the LBO deck and then rip through this case study. And once again, sorry about all the delays and stuff. I know it's like a weekend, probably a bit bored, but appreciate it anyway. Okay, so let's open up this LBO slide deck and jump into it. I'm not sure how familiar you guys are with LBOs. I'm sure you've like heard of them and stuff. So I'll just kind of go through the basics real quick. Sorry, I'm losing my voice there. So let me just see. How do I share my screen here? Share, show. Wait, what? Okay. Okay, here it is. Okay. Oh, it doesn't allow you to share your whole screen. That's interesting. No worries. Okay, we'll just share this doc for now. Okay. All right, so I set the slide deck. You guys can take a look later as well. I'm gonna just turn my camera off for a second here. Basically, long story short, this is my little spiel about whoops, my business. Actually, let me get out of presentation mode for a second. Okay. Actually, let me go back now. All right, cool. So I don't know why I have this. Okay, there we go. Basically, okay, what is an LBO? First of all, you probably heard of it. You know, you buy a company with debt. It's like a mortgage, right? When you buy a house, yeah, you can buy with all equity, but people usually, take out a mortgage. Why? Because you can reduce the amount of actual equity you have to put in, right? Whoops, sorry. And therefore increase your return as well, right? So that's kind of the whole private equity idea, right? You borrow, you reduce your equity on a smaller equity base, you can have a higher return in the end. It's also riskier though, so that's the downside. But with private equity, right, the idea is like you got a bunch of money, you don't want to dump it all in one company. So what you do is use debt and then put less equity in each of those companies. And ultimately, usually 40 to 70% of the company's often debt. So that's the whole structure of private equity. And the idea is like if the company goes bankrupt, but it's on the holding company, so it doesn't affect the private equity company. So it's a unique structure where like their holding companies go bankrupt, but it doesn't affect the parent. Anyway, but it does affect their reputation, which is important to you. Okay, so and the returns. Okay, how do you actually make money in LBO? There are three ways. I think the ways I go through here are two ways actually. So I'll go through the ways that I've shown here. So one way is paying off debt. This is very straightforward. It's like if you buy a house, right? Even if the house does not increase in value, I'm gonna turn my camera back on actually. Let me just see if this works. Can you guys see like my camera jumping around, or is it not working? Just curious. Oh no, it doesn't work. Okay, because I'm using a standing desk right now, so I'm just gonna turn it off because it's probably gonna be distracting. Okay. All right. So back to this. Yeah. So if you pay down the debt, right, you own more of the company as you go. So maybe you borrow at first 50%, right? And so you borrow $100, you buy the company for $100, and then you start paying down $20 of debt every year. Well, every year you're going to increase your equity ownership percentage, right? Because the more debt you pay down, the more of the company you own. Same thing goes for a house, right? If you paid off the mortgage, you own the whole house now, right? So it's the same idea. The value of this company has not actually changed. It's 200, like it's still be $200, but now we own 100%. So we've doubled our money just by paying off the debt. So paying off, using the cash flows, pay off debt is a classic way to drive returns. The other way that I haven't actually made a slide on, I probably should, is to just increase the EBITDA. So, either by increasing the revenue, which is the most common, or by, reducing costs, which can happen as well. And the reason that improves the company is because most of the times companies are like valued off EBITDA. So like you might buy a company at 10 times EBITDA and then sell the company at 10 times EBITDA. But if that EBITDA has gone up, so has your enterprise value. All right, great. Sorry if this is review, by the way. I just want to make sure everybody's on the same page before we kind of jump into advanced stuff. Okay, what about multiple expansion? That's like the third kind of like I think mathematical way. Like if somebody asks you like, what are the 10 ways to increase IRR? You can literally say anything. You'd be like, I don't know, like cut costs, grow into new market, whatever, like do a dividend recap. But when people say, what are the three like mathematically like most important drivers of IRR? These are the three, right? Paying off debt, increasing EBITDA, and the third one here is multiple expansion. Multiple expansion is basically when you've actually improved the outlook of the business such that when you sell the business, you're going to sell at a higher multiple than when you bought it at. This is actually pretty rare. In most LBO models, it's the multiple that you sell it at, your exit multiple, is going to be equal to your entry multiple or lower, just for conservative purposes. Why would it be lower, by the way? Well, let's say you buy a company, it's a relatively small company, fast growing, and by the time you sell it in 5 years, it's no longer a fast company or a fast growing company. It's actually a more mature company. And now the comparables are also more mature and the industry is more mature. Well, now you have a growth rate that is not as attractive. And that's why you sell at a lower multiple, but you could still make good money off it because you just got such good cash flows in the beginning. That doesn't really matter. So it's rare to expand multiples, but it is possible. When would it what happen? Well, when a P firm jumps in and fixes a bunch of problems and turns the thing around, selling this company is worth more on a multiple basis than it was before because it's more attractive. You fixed all the problems. One classic example I use, which is very ancient, probably makes me sound old, but I think it was like ages ago, probably a really long time ago, that Onex bought Spirit Aerosystems. It was like a division of Boeing. And at the time, that division was going through a union strike. And the rules is that if you have a union strike, the whole company has to do a union strike. So all of Boeing has to do a union strike. And Boeing was like, we don't want to do that. So they sold that part of the company to Onex. Onex literally just renegotiated the labor contract, and they made 180% in 6 months. Was their IRR, I think. So 180% IRR, and they literally sold in 6 months. It was like just flip it pretty much. So that's an example there. Okay, great. All right, so let's keep going here. So I want to save more time for the actual modeling, so I'm going to rip through this a little faster now. Okay, what makes a good LBO candidate? By the way, if you guys have questions, just like, I don't know, raise your hand or whatever. I'll probably see it. Okay, so what's a good LBO candidate? Long story short, recurring cash flow is the most important thing. Like, cash is king, right? Like, you want a business where the customer is like a subscriber, right? Where it's like, okay, they're on contract, they're probably not going to switch. We can count on this revenue happening again and again. And why is that good? That gives us stable cash flows. Stable cash flows allows us to pay down the debt, which allows us to drive RR. And also allows us to not default, which always sucks, right? So you have PE, like, it's a debt business, right? So you have to make sure you have cash every month, and you can meet your covenants. Okay, what else? Like, low capital intensity, same idea. You don't want to like spend a lot of money CapEx. That's annoying. You don't want like tons of money tied up in networking capital. But opportunities actually improve the business. Like, are there growth opportunities? These days, more and more PE companies are like, okay, that's all great, but where's the growth? Is there an opportunity to like grow a new market, do a new product, cross-sell to existing customers? Is there an opportunity to smash this business with another business, combine and have a better market share, be able to serve larger customers in a field that is fragmented and doesn't have enough mid-sized players? That could be an opportunity, right? But there's other opportunities as well. Margin expansion, like sometimes things aren't efficient. Like when I was in PE, we encountered a lot of companies that just had way too many VPs, like way too many. We're like, why there's so many VPs, right? Like, your SGA is crazy, and you don't want to be that guy who's like, you should cut your VPs. But sometimes you have to, there are less sexy parts of PE, but like sometimes you have to look at costs as well. Okay, so anyways, that's the quick scoop on that. And obviously there are other things like valuation and whatnot. And having a large asset base is actually important. People don't mention that because like you can actually borrow money. You need a company that can actually borrow. Otherwise, like, it's not really an LBO. Okay, cool. So these are some examples. I'm not going to go through them. Long story short, in the prehistoric times, Onex bought Husky and they made money because they like. Oh yeah, this is kind of a funny story. They literally like just used organic. They used regular chicken instead of organic chicken in the employee cafeteria, and they saved 100 grand annually. I don't know, silly stuff like that. And they also like the owner like would for some reason not source materials from Canada, so like they just source from China, which is obviously cheaper, especially back then. Anyway, all kinds of ways to make money in PE. All right. What about the actual financing? Common interview question would be like, how do you finance an LBO? Well, there are basically two kinds of debt, right? There's senior debt, junior debt. You've probably like seen some of these terms like term loan A, revolver, and you're like mezzanine. You're probably why there's so many? Just think of a senior, junior. Senior is provided by the bank. Long story short, and it is a lower interest rate because it is higher claim on assets, and the banks, usually it's the same bank that will give you the term loan A and the revolver, often at the same interest rate, sometimes different, but often the same interest rate. And the revolver is like a line of credit. So you basically draw on that anytime you're short in cash. You're going to see through a model, we're going to be drawing on the revolver. So, or maybe not, but you'll see how it works anyway. So it's like, it's a line of credit. You can't go over the maximum, but you can pay it off anytime. You can borrow anytime. The term loan A is like a normal loan. So you can prepay it. You just can't like borrow more. It's not like a credit card like the revolver. So, revolver is great for financing short-term transactions or whatever. Term loan A is like you just borrow it. And they usually the term loan A, they make you pay 1% of the principal every year. So that's another thing. So you can prepay it. They make you amortize it. Like if you don't pay that 1% principal, you default. And it's a floating interest rate based off LIBOR usually. So that's a quick scoop about senior debt. Term loan B is like the same thing as term loan A, except it's provided by like institutions instead of banks. All right, let's jump to junior debt. Now, if a company maxed out on senior debt, because they probably want to max out on senior debt, it's cheap debt. And the bank's like, yeah, we're good. Okay, you got 4 times from us, like 4 times EBITDA. That's how they usually measure it, by the way, like off EBITDA. Like, yeah, we don't want to give you any more senior debt. And, okay, you're like, but I need more debt because I need to bid a higher price so I can win the deal and blah blah blah, whatever. You need more debt, you go to the junior debt, and you go to institutions, hedge funds, private debt funds, right? Who want more risk. So they'll give you mezz, they'll give you sub notes, higher interest rate, fixed. Can be high sometimes, like 10, 12%, like it's actually pretty high. Whereas like, floating is more like 7, 8% with LIBOR these days or whatever it is. Like maybe not even actually like 6 or 7%. So like, but here's the thing, there's no amortization. You cannot prepay it. So that's actually a negative for you. And then the other thing is mezz is interesting because you can use PIK debt interest. You're going to see PIK is very common in LBOs. What is PIK interest? PIK interest is basically when you don't pay the interest in cash. Like you might have heard this before. It's called payment in kind. So it's like, okay, I got all this. If a PE firm is like, I want to do add-on acquisitions. Like I bought this little beachhead, this little small company. I want to roll up the industry, but that's going to cost money. And this company like doesn't have a lot of cash flow. So I'm going to ask if I can do the interest in PIK. And so I don't pay the interest in cash. I just let it accumulate. So the debt balance accumulates and I pay it in 5 years. So it's like a line of balance, a line of credit that you don't pay for 5 years. And like the interest just accumulates as debt. That's pretty much it. Okay, great. So that's that. Debt always has covenants. You can read this more, but the most common ones I would say are leverage ratio, like debt to EBITDA is by far the most common way to think about debt. So like in PE, you often see companies levered, I'd say like it can be anywhere from like 4 to 7 times, to be honest. Depends like if you're in the States or whatever. Like the States will go higher, and also depends on the company. I've seen companies leverage as high as 8 times for PE because it's like a really great growth company. But like if it's just a normal company, it might be like 5 times, right? Like tech company, maybe 4 times if it doesn't have like a lot of crazy growth or whatever. So a lot of things factor into this. Other things that factor is the fixed charge coverage ratio. You can think of this like EBITDA divided by interest. This is like the more complicated formula, but it's basically just saying like, okay, how much money are you making, like how much cash you got, and how much can you pay your actual like your debt service? Like, are you gonna like if this is really low, then I'd be worried because maybe you're gonna default 1 month, and then that like when you default, basically the lender comes to you and is like, well, you defaulted. So legally we can take everything, but we're probably going to like discuss with you and just come up with a new terms of debt. You don't really want to have the discussion if you can avoid it, right? So anyways, okay, so I don't want to spend too much time. I think we're pretty much wrapping it up now, but the last part I just want to kind of go over is the actual the IRR. Like what is IRR? Common question. Like IRR is basically, if you think about it, like if there's nothing happening between the years of buying and selling, it's basically just a compounded annual growth rate. That's all it really is. Like it's, you can take that formula and just literally, that's basically your IRR. Or you can do the Excel way, right? Now, the reason you might want to do the Excel way is because sometimes you get like stuff that happens in the middle. In private equity, like they might go back and go for a capital call and be like, hey, we actually need more money because we've decided that we want to do more add-on acquisitions. We found a great investment, but like you, Mr. Investor, need to give us more money. And the investor's like, okay, fine. And so they they do it, they give them money. That's what's happening here. But on the flip side, they could also be like, wow, we paid down a lot of debt. We actually could take on more debt, but we have nothing to do with it. And they're like, well, why don't we just pay ourselves? So that's what a dividend recap is. It's taking debt on a company and then using the proceeds to pay the investors a dividend, which seems sketchy because it like levers up the company, but doesn't actually improve it in any way. But it's perfectly legal because you own the company. You can do what you want. So, like if this would be the accounting entry, by the way, like you get debt, your equity goes down. So like it kind of looks sketchy in the balance sheet, but it definitely happens. Because, maximizing IRR is the name of the game. So in this situation, you're going to have to use Excel formula because there's like stuff happen in the middle. You can't use this CAGR formula. Okay, cool. Yeah, these mental math. I won't go over this, but you've probably seen some of these like quick solutions. These are just memorize these, and you're pretty much good. yeah, I kind of mentioned like ways to improve okay, the actual modeling steps. Okay, so today I'm going to go through a typical case study. I might not have to go through the time to go through the whole thing, but I'm going to try my best to do what I can. And then if not, I'll just kind of like walk through the rest of the model because I have the model done already. It's just okay. So, but these are kind of the steps, right? You make your assumptions, you create sources and uses, and then you project your three financial statements without the effect of debt. Key. And then you build a debt schedule, and then you put in the effects of debt. Now, one thing I'm missing here that I might want to add later is you also have to adjust the balance sheet for the transaction. So I probably should add that somewhere. But anyway, after you've done all that, you build your exit waterfall, you get RR, boom, sensitivity. So easy enough to talk about this in an interview. That's all they really expect you to do is just like say this, and you know what it's for. Like, that the point of the sources and uses is to figure out how much equity is required, right? Because you have to like pay for the company and the fees and all this crap, right? So anyways, as long as you know like the steps, that's good enough. But let's say you want to know more because you're watching me do this and you're like, okay, why not? Well, that's where we're gonna do the good old case study. All right, so before I continue on here, first of all, is everybody following? Like, is this like too nuts right now, or is it pretty good? I know I talk fast and stuff and whatever. Okay, I see no hands raised, and that means everybody's happy. That's my way of interpreting that. So, okay, let's move on. I will occasionally be turning my camera on just because I use a standing desk, and for some reason I cannot figure out why my other webcam's not working. Okay, I'm just gonna. No, is there like a chat section here? No, I guess not. Okay, so you just got to raise your hand if you want to say something.
The chat thing is next to the people icon on the left.
Okay. That's weird. Well, I don't know why I see it, but it doesn't really matter. If you just raise your hand and I'll. Okay, yeah, but feel free to ask questions. All right, let's jump in the case study because I'm sure that as fun as that was, that's probably like not all you want to see. The good stuff is here. All right. This is a nice little case study because it's called the 1 hour case study. I don't know anybody's done. Actually, no. I know one person who's done this in 1 hour. I literally know one person. I took longer than an hour. I'll tell you that much. Because it's like, yeah, I think it's a 2 hour version to be honest. If not 3, but like 2 for me. Okay, so, but what's nice about this is that the assumptions are simple first of all, but there's a little nits. Like there's a minimum cash balance. They want you to refinance existing debt. Like you might not know how to deal with that, right? Like there's an M&A, okay, the M&A fees, whatever, but there's options.
We're seeing the PowerPoint. We're not seeing the Excel.
Oh, right. For some reason, yeah, maybe I should have done this on a Zoom or something, but okay, let me figure out how to do that. Sorry about that. Thanks for pointing that out. By the way, that could have been awkward. Alex, do you know if there's a way to share your whole screen? Actually, you know what? I'll just do it manually. It's fine. So let me just go stop
when
sharing.
When you press the share button,
yeah,
there's two things that pop up. There's screen and window.
Yeah.
So you want to press screen.
Oh, this one, right? So you guys see that now? The PDF?
Yeah.
Perfect. All right, we're in business. Okay, let's do it. So hopefully the next until 5:30ish or so, we may go over that a little bit. If we do, you have something planned, just leave, whatever, it's fine. Okay, so but yeah, so there are little nits to this, right? So there's options. I'm gonna go over what management options are in a sec, but basically they're like it's like giving 5% of the upside to management to keep them like incentivized. Here's the debt. Okay, so the debt's straightforward. They give us, it's usually given in terms of EBITDA, right? Like different kinds of debt. They give us the interest. There's actually a commitment fee. So that means sometimes there's like a fee charged on the amount of the revolver you haven't drawn. So it's 0.5%. There's some mandatory amortization on the term loan, 1%. There's some mezz interest of 5%. I ignored this, by the way. This is kind of stupid. I just didn't feel like doing it. The OID. OID stands for original issuer discount. It just means that like by the time you actually like take out the debt, like the debt market has changed, and suddenly you have to like reduce the loan amount by 2.5% because like interest rates have like risen or whatever. But I was just like, I don't know. I just didn't feel like doing it. So I didn't do that. But maybe I should at some point. Anyway, because I'd literally never seen this in other case study. That's why I didn't do it. I was like, never seen this before. I don't know if Alex have you seen this before? Original issue discount? I've never seen that before. Anyway, okay. but it's pretty straightforward. Like you literally just take out less debt. Like that's all it is. Okay, a financing fee on term and mezzanine loan. So oh yeah, so there's a fee. Yeah, so this fee amortizes, by the way. Financing fees amortize over the life. So that's why that's important that there's like a 10-year life. So cash interest of 1%. Okay, and use average balance to calculate interest, not opening balance. All right. So what else we got going on here? So yeah, you can see this case study has some hair in it. That's why it's like a good one to go through. Purchase accounting, right? So like when you actually do an LBO transaction, you have to adjust the balance sheet, and oftentimes you just you put in the new debt, so you like credit. You basically like debit any old debt they had, credit the new debt, you debit any old shareholders' equity they had, which represents whatever was invested before, and now you credit, right, the new shareholders' equity, which is the money the equity investors are putting in. And normally we just put the difference to goodwill, but now they're saying actually allocate 15% of that excess amount, right? Because realistically, you're probably going to be paying like more for the company than the book value. Like that's just always how it is. But that excess amount over that book value of the company, 15% put it to PP&E, and then make it a 15-year like DNA for that. Okay, cool. So what else we got going on here? We got working capital is basically like flat every year. Sorry, oops, that's a little too much there. So that's pretty boring. And like this stuff's kind of like really straightforward. It's just like, yeah, revenue growth 10% every year. They kept it simple here to try to challenge you more on the mechanical aspects. They give you some capex info, some balance sheet info. Okay, great. So we know what case study is all about now. Let's actually jump into the case. So what do you do when you get a case like this, right? Like somebody gives you this, they're like, you have 2 hours, go. This will determine the rest of your career. And you're like, oh, F, you know, like, what do I do now? Well, first of all, you should probably practice this before you actually do a case study in a private equity. And realistically, you probably also have done investment banking. But sometimes, like, you know, you haven't because it's like an entry-level role. So this is where this might be helpful. Or maybe, you know, one day if you ever do want to do PV, it'll be helpful. So let's take a look here. First of all, I like to put everything in one sheet. Now, in actual private equity, you may not do that. You may, like, just to give you an example of what like an actual model might look like here's one I did in my previous role. I don't know if whatever. This thing has been like out for so long that I don't think it's really a big deal. I show you this. It's bought by Birch Hill, it's a knife sharpening company. Like an actual LBO model is going to be a bit more complex, right? Like I have this thing like built monthly and whatever, right? Like and there's like 11 different financing scenarios. So like, yeah, in this case, say you're gonna want your inputs on like a different page because I have like 10 million things going on here, and I have like 5 scenarios and whatever, right? So yeah, but for a case study, put it on the same page. Why? Because it's just easier. You can reference everything, like your formulas will look simpler, whatever. Okay, so the assumptions I've put here, I already kind of went through these. I'm not going to go through all of them. But one thing I will go through is I did calculate like basically so these are the assumptions up there, but what I did with the assumptions is first, very simply, I want to know what is LTM EBITDA. So I think they didn't actually tell us that. So or maybe they did. Sorry, did they? They did actually. Sorry. So that's yes. So it's like a hard code number. I actually backed. I think I backed into like the rest of the numbers because they didn't tell us like SG&A, but they did tell us like gross profit. So you know, not too hard to figure that out. Okay, but so first thing I did, take that EBITDA, multiply by the 9 times. We got enterprise value of 2.7. This would be billion, yeah. So and then of course, basically figure out like yeah, this is just more. I think I just did this just for like just as like a check. This doesn't actually drive anything, but what does drive something is the sources and uses. Because I said the first step, transaction assumptions, done. Second step, sources and uses. Okay, this is how you do it. Do the uses first. That's a little like counterintuitive, but just do it first. And this is a unique company, so this would normally just be like, whoops, sorry, like the sum of these two, to be honest. This like it's equal to enterprise value, right? This is like, sorry, like here. So this purchase equity would normally be 2.7 billion because that's how much the company's worth. However, because the case study said you have to refinance debt, I just added the 500 here, refinance debt, and I took 500 out of that. What does that mean, by the way, refinance debt? It doesn't mean anything, to be honest, because they gave you the debt terms. So like, yes, you're refinancing it, but like, really actually care what the debt was before. I just have to do it on my source and uses just to show that like I read the case study, you know, like, and that I've like accounted for this in the source and uses. So that's what that is. Like, you know, yes, we're buying the company for 2.2, but we're also going to use 500 million to refinance the debt, and then so that's where that comes from. Okay, what about the rest? Well, there's always fees, right? And there's a minimum cash balance. We have to make sure we keep 25 million on the cash balance. So that's what that is here. So we have to make sure that's funded. Then we also have to pay for the fees. So I think the fee was, I think they just gave it to us. It was like straight up just 20, like there's nothing there. It's usually a percentage of the enterprise value. Financing fees was a percentage of the debt, which is very normal. Just terminal and mezz though, for whatever reason. Yeah, that's fine. So that's the total usage. So you add this up. This is the actual money you're spending, right? Because at the end of the day, as we all know, like you buy something, that's not the actual price. There's always fees. So now that you got the total amount, now we just have to figure out how to finance that. So make your total sources equal to the total uses, right? That's the key here. And then what you do is you put on the debt. So I calculate the debt, right? It's all just multiples of EBITDA. And then you want to put you also want to account for any cash on the balance sheet, right? So because now, if this was a cash-free, debt-free transaction, I would say no, ignore the cash. In fact, ignore the refinance debt part too, right? This is not cash-free debt. I don't think. It'll be embarrassing if it is, but I don't think it is. Yeah, no, I didn't see anything about that. So if they don't say it's cash-free, debt-free, and they tell you specifically to refinance the debt and all this stuff, right? That means you're going to be buying the whole company, including their cash, right? When they say it's cash-free, debt-free, they're just like basically saying like, you know, we have cash, but don't worry about it. We'll just net it off. You don't have to like quote unquote buy our cash. Well, guess what? Right now you are buying their cash, but their cash is also a source. So long story short, yeah, you're getting the cash that they have in their balance sheet of 50 million. Okay, the rest is going to have to be invested by the equity holders. So these two right here, I'm just going to bold them real quick. This is the plug. And so the way we do the plug, we know that 90% I think is sponsor and then 10% is management. So we're just basically taking the difference between the total sources and the debt and all that other stuff, and then just multiplying, you know, in this case 90%, in this case 10%. And these are the two key numbers. Actually, this is the most important number. This 711 is what we're putting in, and you'll see that in the IRR calculation. That is the first number. That's why that source and uses is actually important. Okay, so got that done. Let's jump into statements. What's going on now? So, okay, you know, originally I was gonna say I was gonna build this from scratch. Now that I'm thinking of it, I think it's just easier for me to just walk through it because it's yeah, I don't know. It's probably gonna be like not enough time to do that. So let's just do it this way, and that way I can kind of like answer any questions better. I think that's probably more useful with time because it's like, do you guys really want to watch me type like word revenue and cost? You probably don't want to watch me do that. Okay, so I'd rather just go through this step by step. In the income statement, it was pretty straightforward, right? They told us 1 billion of revenue, growing by 10% every year. Okay, easy enough. You know, same thing here, constant margins. So this is all pretty boring to be honest. It's all just constant percent of sales. So yeah, very easy balance sheet. Now your income statement. Now after you do the income statement, here's the thing though. You know, I will play around with this just to show you stuff actually. So like, that way it's like a little bit more interactive. I will play around with this, and the way I'm going to play around with this, I'm going to close this guy because it's a beast. Long story short, I would not do this part, the interest expense. This is obviously going to make my model not right, but let's do that for a second. So because normally we don't have the debt schedule yet, so just do everything but interest, right? And then for cash flow statement, you know, it's a classic like, yeah, like start with net income, add back your non-cash stuff, whatever. And hopefully you guys are pretty familiar with the cash flow statement, but you know, this whole part, the financing part, we're just gonna leave that empty. And I'm actually just gonna delete it because it may be helpful for me to actually just put it in later so you guys can see what's going on. So yeah, all this stuff is pretty straightforward though, I think. One tip, by the way, when you're modeling, just quick tips, by the way. First of all, I like to go. A lot of people do this, right? Like I'm just gonna get rid of the border for a second. A lot of people will do this. They'll be like, oh, I'm gonna do a line underneath the thing, right? So like, what did I do there? I'm using shortcuts here, but like specifically like bottom. Quick tip: always go top border. Okay, this is the first thing I learned in investment banking. It's just stupid. And also, one of the first things I learned was also, wait, are people in the lobby waiting? Alex, I don't know if.
You just had to rejoin.
Okay, okay. So just want to make sure. Yeah. So Alt VWG, get rid of grid lines, and then add that line. I like to always add the years at top. You can also add like like a title of some sort, like LBO case study. I didn't do that for some reason. And then of course add like the units here. And then what I like to do is I like to fix the frame here. So that way I can like, go all the way here. I still know what's going on. I can still see the years up top. I don't have to like paste the years 10 million times. But you can still like repaste the years just if you want, because for like presentation purposes. But okay. So yeah, that's this is like where I like to format things. Like another quick format tip, by the way, not to get too distracted here, but like your custom formatting, try to find one. Like if you guys, I don't know, like I can send this over. Wait, is there a chat here? What? I'll send it on Slack, I guess, like in education. So this is what I do. Go to a blank Excel sheet. Education. Number format. You might already know this if you've done like internships, right? But just go Control A, press Control 1, which is format cells. Go to custom, and then just paste what I just put in. What does this do? Well, now any number type is gonna just automatically like look nice, and then if it's a negative number, it'll like have the brackets, and if it's 0, it's gonna do that, and it's like all lined up, all that fancy stuff. So that's important. Okay, all right. The other trick I have, by the way, is the new window trick, which I think I already did. Let me redo it again just for fun. So Alt WN, and by the way, you don't have to memorize these. It's like Alt. What am I actually doing here? Alt W. I actually don't know how to do this without shortcuts. Alt W. Whatever. It's just Alt W. You know what? I'll just type it. I'm gonna send actually a thing with shortcuts. So I don't have to like. Yeah, I'll just send a file with shortcuts after. Okay. So new window is great because now I can look at two things at once, right? So now I can be like, okay, great. I can fix this side too. Now I can look at two things at once. Lovely. Okay. Why would I want to look at two things at once? Because I was going to show you, with all my rambling, that I kind of got distracted, the relationship between the balance sheet and the cash flow statement. Because this is something I feel like not everyone fully understands. Everything that happens in the cash flow statement happens in the balance sheet. And that might seem weird, but it's true. Okay, so like, what do I mean by that? Like, accounts receivable from the balance sheet, inventory from the balance sheet, like all this net working capital stuff's from the balance sheet. So why am I telling you this? Well, when you're doing this, you might end up being like, wait a second, I can't actually find these numbers unless I like figure out what my net working capital is, which is going to go on my balance sheet anyway. So you may find yourself doing like the cash flow statement, balance sheet, like somewhat simultaneously or whatever. In this case, like the way I found, filled out these numbers was by creating a net working capital structure. We were given basically for net working capital, we're kind of told like, yeah, just keep the days like similar to what it was before. So normally the way you do it, right? By the way, net working capital, if you don't know what it is, it just represents money tied to the daily operation of the business. So like inventory, you need shoes. So you need shoes to buy you need shoes to have a shoe store, right? So you're gonna have to buy inventory. You're gonna have to dump money in that business. You might have more and more money. You also might have people who owe you money, and you might also you might also owe your suppliers money. So there's a lot of quote unquote money owed or whatever going on, and or money invested in the daily operation of the business, right? Because you have to have accounts receivable for a lot of business, and you often are allowed to have accounts payable. So long story short, obviously the higher your liabilities, the better, because like if you take longer to pay your suppliers, that's more money for you. If you can receive your money faster from your clients, that's also more money for you. So that is basically the concept. So any increase basically represents a cash decline. So what I did actually is I calculated like the difference between the current assets, current liabilities. Note that this doesn't include like cash and all that stuff. Like these are pretty much the things it includes. Maybe prepaid expenses, right? But like or other current liabilities, but it does not include debt paying liabilities, does not include like tax liability. Like it's just operational stuff, right? Not like other things. Okay, but anyways, so notice that this number is negative. The reason it's negative is because I actually took the previous year subtracted by the current year. I do this because I want everything in my model, the direction to be correlated with the impact on cash flow and net income. This is also something that I learned during investment banking training, is like do not have like a lot of like this minus this. Actually, don't have any of that, preferably in your model, because that's how you make mistakes. Is like you forget a negative sign, and suddenly like this perfect model is completely wrong. No, don't do that. So that's why I did this, right? This represents cash outflow. Anyways, but how do I get these numbers? Well, okay, so day sales outstanding. You guys may have heard that formula before, or that term before. You can just Google it. It's like it's a hard formula to remember, but like, long story short, you know, it's like it's basically taking the it's basically saying like how long does it take for your client to pay you? And the way you find that out is like, okay, well, first of all, what's our accounts receivable? Let's divide that by revenue. Okay, great. Well, now let's multiply that by 365 because that's how many days there are in a year. If you're wondering why that math is the way it is, I don't feel like explaining it, but it makes sense, right? Like it's like accounts receivable divided revenue. You multiply by 365 because you're trying to like you know, figure out like within like how long it in terms of days it takes for them to pay you. I'm not in terms of like percentage of a year, if that makes sense. But anyway, I won't go on the math too much. It just is what it is. Days inventory held, same idea. Take inventory divided by cost of sold times 365. You know, try your best to memorize these. You know, accounts payable divided by cost of goods sold times 365. Now, in the future, we're just going to hold these constant. And this one's just percentage of sales. That one's kind of easy. Hold these constant in the future. This is very common, by the way. This is what you almost always do. And then you could project your future accounts receivable, inventory, accounts payable, whatever, based on your revenue, cost of goods sold. So that's kind of how you do that. Okay, so that's net working capital. I want to go spend more time on that because people often get confused by the concept, but that's what it is. All right, so that is what these things come from. This is like our change in net working capital. So it's like it's down 15 like the first year, which is consistent with what we just saw like in the schedule, right? That's another way to check it, by the way. Okay, cool. So we got that part of the cash flow statement done. And what about PIK interest, by the way? I mentioned this. This is we're adding this back, right? Because it's non-cash. So but to be fair, if we're doing this, let's say without the debt first, it would just be empty for now. Okay, CapEx is just like 2% of sales or whatever, I think. Yeah, so that's pretty easy. Now this is the key line. The most, if you learn nothing from this session, because I've been rambling on about too many things, learn this. Cash available for financing activities is the most important line in the LBO model. And now you're probably wondering, why have I never heard this term before? Well, because I don't actually know what it's officially called, because nobody actually has decided what's officially called, because I don't think professors teach this. Some people call this some people call this levered free cash flow. I don't think it actually is levered free cash flow because it's not. But anyway, this is what I call it. Cash available for financing activities. What does that actually mean though? This is the money that determines if you need to borrow money or if you can repay debt. And you can see right now it's positive. That's good. But this is also because I took out the interest, but we'll throw that in later. I'll show you how. Okay, so yeah, this part's empty for now. Okay, so that's kind of pretty much that. Okay, let's jump into I'll go over what this is. This is a check, whatever. It's like bridging EBITDA to cash, just to make sure like I didn't screw up. Obviously, this is not right now because I took out all the debt numbers. Okay, let's jump to the balance sheet. Okay, so the balance sheet, the most important thing I want to go through is how to adjust the balance sheet for the transaction, because everything else is straightforward. Like I kind of went through accounts receivable and inventory, all that stuff. PP&E I didn't go through, but normally you would build a schedule. I got a little lazy here. So I just like took the last year's, subtracted D&A, added CapEx, but it's probably better to build a schedule. And the reason you should build a schedule is especially if depreciation is based off a percentage of the PP&E. And sometimes it is, right? Sometimes they'll be like, it's based off of like let's say it's a 10-year useful life on average for all the assets. Well, then you would take 10% of your beginning PP&E balance, and that would be your depreciation expense, right? So that's why you have to build that schedule, because you have to be like, okay, what's my beginning PP&E balance? Actually, a picture's worth 1,000 words. So I'll just show you. Whoops. So you'd have like beginning balance. Whoops, sorry. And you'll notice that as you model more, everything is in schedules. It's all about schedules, right? CapEx and less D&A. Ending balance, right? And you just keep doing this every year and figuring out your D&A is going to be percent of the beginning balance, and so that's why you build the schedule. Okay, so hopefully that makes sense, but we don't need that because D&A was like a percent of sales. It was really simple. All right, now what about the adjustments? Let's get to the fun part. Well, fun for me. I don't know. This is probably not fun for everybody, but okay. So how do we adjust the balance sheet? This actually like used to infuriate me when I was trying to learn LBO modeling by myself. I was like I would do this and then stuff wouldn't balance. And I'd freak out. I'd be like, oh my God, why is it not balanced? As you do this more, it'll just balance, like, because you'll just, I don't know, get a hang of it. Here's the thing. I actually like to break it down accounting style. Everybody does this different ways, but the reason I like to do it accounting style, maybe it's because I took like too many accounting classes when I was like in high school or whatever, but I just think of things as in debits and credits. It's like really like intuitive for me. So like, for example, one of the simplest things we need to do is just get rid of the old cash, put in the new cash, right? That's not a super complex thing, but it's like, so the old cash was 50K, if you remember, or 50 million, and the new cash, we have to put in the minimum cash balance of 25 mil. So that's where that's from. So that's done. Okay, great. What else we got to do? Take out the old debt, put in the new debt. So the old debt we know is 500, and it's quote unquote being refinanced, but we're still just gonna like dump it into whatever, like it doesn't really tell us how it's being refinanced. So we're just gonna put it into the new debt. So yeah, that's what's happening here. And then finally, shareholders' equity. This is just what was on the book before, and now this is sort of the new shareholders' equity, which is a sum of the money from that vested from the source and uses, the sponsor plus whatever the management's putting in. By the way, management almost always puts something in because you want management to be incentivized. Otherwise, they could just like leave and you'd be like screwed. But if they leave, they have to sell it. That they like don't, their shares are not going to vest. So yeah.
Are they actually putting money in, or are you giving them shares for free?
No, they're putting money in. Like we're being like, yo, CEO, like we want you to be serious. Put your skin in the game. We want you to take 10%, right, or 5%. And it's not just the CEO, like the CFO, all the senior management. And to be fair, normally they already have a stake in the company. Like probably like oftentimes the CEO is the owner, right? So like their stake, they're not putting more money in, they're just leaving some of their stake on the table a lot of the time. Not always, I guess, but okay. But options is different. I'm going to go through options, which is like giving a percentage of the upside to that person, but that's the whole different ballpark. Okay, ball game, I mean. Okay, so sorry. Okay, so back to this. So that's how shares equity is. We get that. Now, normally, right? I would not have this. It would just be goodwill. I would just be like, oh, these two don't balance. Okay, what's the number that makes it balance? And I'll, take the usually the credit side is going to be higher because usually the new stuff you put in is going to be worth more than whatever was on the books before, just because of accounting, right? But so usually usually have a debit account of goodwill, and so because almost always you pay more than the book value, right? So that's what that goodwill represents. It's just the credits minus the debit, and so now the debits can balance. However, this assignment specifically said, or case study specifically said, to put 15%, and I did this kind of hack. You should probably link this to an assumption, but whatever else, lazy. 15% of the excess to PP&E, and then the rest to wait, did I do this right? Sorry, I just want to check something. Okay, I might have made an error here actually. So sorry about that. But it's good. I got it. I was like, wait, what am I doing here?
The debit to your PP&E should only be the write-up amount, which is like what 15% of the excess purchase price.
Yeah.
And
so
I think you've done it to the entire purchase price.
Exactly.
I could be wrong. I don't know.
No, you're right. So what I should have done is I should have gone. So I'm just gonna fix this right now, actually.
So while Josh does that, eventually, all of you should be faster than Josh at Excel. And I say this because this is Josh after having not been in banking for like 5 years or more. So this is rusty Josh. So for the rest of you who are entering the industry to be competitive with the rest of your peers, you must be faster than Josh.
By the time you do private equity, yes. I mean, yeah. Anyway, okay. So, so sorry. Let me just fix this up a little real quick. Wait, what the? Okay, I might have messed this up a little. So what am I doing here? What's going on? Why is this Oh, sorry. Order of equations. Sorry, I was confusing myself there. I was like, why is it not working? Why is this not working? I just need a bracket. There. So what I did here was I messed it up originally, actually. So it's a good thing I fixed it here. Is that what I need to do actually is take the difference, right, between the credits and the debits, and then multiply it by 15%, because they were allocating 15% of the excess to PP&E. And then the rest, which is 85%, we're going to allocate to goodwill. So that's what's happening there. And as you can see, both sides balance. Hopefully that didn't confuse you too much. Okay, so we've done that. That's the accounting. Now, how do we actually put these adjustments into the balance sheet? Well, long story short, this is how you do it. I like to do it on the side here, just like, nice and clean. And I have a pre-transaction and post, and I like to have adjustments column in the middle. And you can see all my adjustments are linked straight from this little accounting thing I did. So this makes it easy because I don't have to worry about this not balancing, because it's like this balanced, right? And everything should balance. Like, trust me, the worst thing you want to have is a balance sheet that doesn't balance, and you're like freaking out because you have like 10 minutes left or something, whatever. So you want to do this right. So which is why I take my time to do it. Although I clearly made a mistake earlier, but we don't talk about that. We won't talk about that. Okay. But yeah, so that's where the adjustments coming from. As you can see, we add them. Now you have the new balance sheet. Like Sherwood's equity, for example, this actually went down a little bit, which is rare. But in this case, the book value of the equity was higher than the equity we're putting in. But to be fair, we were also leveraging it up. So it's not really apples to apples. Okay. That is how we get to this balance sheet. You can see everything just linked like to this post-transaction thing here. So this is the transaction year. This represents like end of 2012. This is very old. End of 2012, the transaction happening. Okay. Now the rest of my balance sheet is gonna be a mess because I've been playing around with like all the debt stuff. So we're gonna have to fix that in a sec. Maybe I shouldn't have done that. I kind of regret that now actually, because but I kind of want to show you how to fill it in. So if it works out, it could be cool. I just don't know if it's gonna work out or not. Okay, so the next step, after you've done the 3 statements, you've adjusted your balance sheet, you need to build a debt schedule now. And so the way you do that is by first like creating it. Just like this is how I like to do it. Create like little separate sections for each piece of debt. Let's start with the revolver. The revolver is like that line of credit I mentioned. And the hardest thing usually people struggle with is like, first, how do I figure out the actual cash flow that determines like, am I like paying down the debt? Am I borrowing more money? Because it's not, I mentioned that super important line, right? Cash available for finance activities, which is essentially cash flows from operations plus cash flow from investing. And by plus, I really mean minus CapEx, because realistically, investing activities is almost always negative cash outflow. So it's almost like a free cash flow, right? But there's other things we have to account for. How much cash do we have in our actual balance sheet? Okay, so that's important. These numbers are all messed up right now. So just ignore. You'll see how they're going to change once I fill in the actual numbers. But like, yeah, we would normally they should all be 25, right? Because we should have just 25 million in the balance sheet, our minimum cash. And then we also have to subtract the actual minimum cash requirement. So regardless of how much cash we have in the beginning, we still have to keep 25 on the balance sheet. So usually the 25 and the 25 will just cancel out like they do here, and the rest is kind of messed up right now. And then finally, we have to also account for the mandatory amortization. This is very easy to forget. This amortization has to be paid. Like, you don't pay this, you default. That's why we put it in here. Like, so this is the actual money like that's left over to repay the revolver in this case. And if it's negative, we have to borrow from the revolver. So the formulas that you use in the revolver, take a look at the model I sent. But I remember when I was first learning this, I was like, oh man, I have to memorize your stupid formulas. Like, ugh. I'm going to do this. One of the best ways is to actually understand what's going on. What is actually going on here? Well, borrowing. What am I saying here? I'm saying if this number here, this cash available, if it's negative, then I'm interested. So like I'm saying like, okay, what's the minimum between this and zero? So obviously if it's less than zero, it's negative. However, if it is negative, I want to borrow money, and borrowing money is a cash outflow. So I'm just going to add a little negative sign to it. So that's all it is, right? It's just like, is it negative? Oh, it is. We need to borrow money. Okay, great. What about this one? This one's a little more confusing, but let's look at it piece by piece, right? Like, okay, the minimum between the beginning balance of the revolver and the cash available for payment. I'm gonna turn on my camera again. Sorry, I keep jumping around between my standing and seated desk. Anyway, so why do we care? Well, we care because you can only repay, you can't repay more debt than you have, right? Like I can't repay more than 150 because like that's that's the max amount I can repay. So basically we're saying like, well, which one is like smaller, right? Because if the beginning balance is smaller than the amount of cash I have, well, I'm going to take the beginning balance of the debt because that's the most I can pay. That's what that's saying. Now the second part is just being like, is it over zero? Is it a positive number, right? Because obviously if we're going to repay debt, we need to make sure cash flow is positive. And that's all that is. And we add the negative sign, of course, because it's going to represent a cash outflow. So once you break it down like that, it's less hard to understand. The formulas can sometimes be confusing, but okay, so that's what's going on there. This is a circular reference, by the way. So like you got to make sure, you know, you've enabled iterative calculations in your formulas, Excel options. Okay. In this case, yeah, interest is pretty easy to calculate. In this situation, I just took beginning balance. Actually, the case study actually said specifically to use average balance, so that was just a shortcut I took. This prevents the model from being circular. But if you were to make this better, what I would do is like maybe do an if formula and then have like a toggle, and the toggle would just kind of be here. Actually, I could just do it now just to show you guys because we still have time. Like we're not like 20 minutes. So yeah, I'm kind of like fixing this model as I go, but that's sometimes how it is. So like we'll call this the average balance toggle or whatever. Average, or how about this? Opening balance. Yeah, we'll say opening balance. So if this is a yes, then we're gonna be doing interest as a percentage of the opening balance. But if it's a no, then we're gonna be doing it as of average balance, which is what they wanted, to be honest. But we're gonna start with yes, because the reason you want to have a switch is because it can ref out your model if you mess this up. Because if it's a percentage of the average balance, suddenly the model is like crazy circular. It's like, oh, what's the beginning balance of debt? But that depends on how much cash we have. Oh, well, how much cash do we have? Well, that depends on our interest, which depends on our ending balance, which depends on, you know, the model will freak out as soon as you like do something wrong, and it'll just ref out. You're gonna want to cry. So good to have a switch here. And so the way you do the switch, by the way, is you just like go to the side here, add a little yes, add a little no. I don't know if this is like the best way to do it. This is the way I do it though. And you know, go do a little alt VV, alt VV, I think is what it is. If you like specifically, it's data VV. I don't know. It's just alt VV, data validation. And what I'm gonna do here is I'm gonna say list, right? So, and I'm just gonna like go to source. I'm just gonna select these two things. Boom. Oh, I got a little fancy drop. Oh, wait, can you guys see the drop down? It's even. There we go. At the scroll. Yeah, so now it's like, you know, a little drop down, just, you know, mildly fancier. Okay, so basically what I would do if I were to do this, you know, more completely, I would say, you know, if this thingamabobber equals yes, or let's say, yeah, yes, then let's go with what I'm doing right now, which is percentage of the open balance. But if no, then, or, you know, let's go average. Oh, what am I doing here? There we go. Why is this mouse is being weird? Okay. It keeps my computer's freaking out. All right, equals average. Why does it keep doing that? It like literally just stops. Doesn't let me type. Okay, let's try this again. If this cell equals yes, then opening balance, and then if no, take the average. Oh my god. I don't know what's going on here. I don't know if Alex knows what's going on here, but I'm confused. Why is it happening? It's probably just my computer is like upset with me or something. Average. I have no idea what's going on with the computer. Sorry guys, technical issues. Oh, maybe I'll try typing it here. Whoops. Okay. If I for some reason can't figure this, I'll just skip this. This is probably not the most exciting thing in the world. S, and then if no, okay, you know what? Let's just type it here so I don't have to like. So what I'm really trying to do is basically like just take the average of like the beginning balance and the ending balance and multiply by the interest rate. That's all. That's it. Not too crazy. Don't know why it's freaking out though. So let's hope that works. Wait. Oh, whoops. Sorry, I should make this like no, because I did the other way around. As you can see, it's still 6, right? After I fixed it. But if I switch this toggle, it's going to be different. So I'm going to apply that change everywhere so you can see the effect of the thing. Cool. All right. So that's how you do a toggle to make sure your model doesn't flip out, and also if your case study asks for average, and then it's good to have. Oh, the other thing was we have to figure out unused capacity, right? So this is how much we're not using, right? So we have to charge, I think it was like a 1% fee or something on that. So that's another fee that we have to pay. Okay, so that's the revolver. Sorry for getting lost in that interest expense thing there. But let's keep going here. So after you've done that, you go to the term loan, right? We know we take out 1.2 billion, and then it's like, well, we also know that we're amortizing 1% of it every year, right? So that is that's happening here, which is just 1%. Now, term loan, you cannot borrow more. You cannot just like it's not a revolver, but you can prepay it. So what we're going to do here is we're going to take this line, cash available for revolver payment, and we're going to say, well, okay, great. Now after that, how much of that was used to repay the revolver? And so that's where this is coming from. So you can see here, basically all of it was used to repay the revolver. This is just adding it from the cash flow statement, by the way. And then here, we paid down the revolver. So we can use the rest of the money to pay down the term loan. So that's all that's happening here. And you can see in the future when we fully pay down the revolver, it's all coming in. Now this is going to change, by the way, because I still need to put in the interest. So a lot of times when you're doing this LBO model, you actually don't know what it looks like until you've actually linked everything together. And we're at that stage right now because I purposely deleted a bunch of stuff. But hopefully that makes sense. So that's term loan. Okay, to be honest, the hardest part of the debt schedule is the senior debt, where you have to like prepay stuff and all this stuff, fancy formulas. Once you get a mezz, it's easy sailing from there on, because I mean usually, unless there's like weird structures, which I won't go into, but like mezz is straightforward, right? Because there's a cash component, there's a PIK component. So the cash component is 10%. Once again, I need to do the whole like equals if whatever. I should probably do that for the other one as well. You know what? Let's do it this way. Actually, yeah, I'll just do it manually. Sorry about this. But I guess I do kind of want to like make this legit for you guys. So I'll resend this updated version too. I guess we're doing no. Yeah, I guess we're doing average of, because it was freaking out when I was like trying to do the other way around. Average of the beginning balance and the ending balance. Bounce over here, and then times the interest rate, and then of course make that negative. Then that should work. Yeah, it's numbers the same. And just to make sure, like, let me just say this up. Not that this is or anything, but just like if I messed around this, like I said, no. Note that how these numbers change a little bit, right? Not a crazy amount. This is like it's such a small amount that it barely matters, but it's pretty much like just to have a circuit breaker, in case your model flips out. Okay, back to business. All right, so we'll do the same thing here. I'm gonna add it to the if thing here. Sorry if that's annoying, but if this thing, and this will be the last one, I think. So then average of opening balance and ending balance times the interest rate. And then I'm going to put a comma there, and of course, to make that negative, and then, oh, sorry, this should be no. I'll double check I did that right on the other one here. Yeah, I said no as well. I'll carry that across. And then I really should just like fix the form. I'll have to do this like 10 million times. So let me just fix it. Just adding this little dollar sign here will means I can just copy and paste it over, which will be nice. Be very nice. Whoops. Assuming I don't mess it up. Oh, right. I just have to move the interest rate, but other than that, we're good.
Hey Josh, how do you have two windows open of the same file?
Oh, that's a new window trick. So on my on my last day, the managing director, I won't name him, but he like yelled at me. He's like, "You don't know how to create a new window? You're an investment banker. You don't know how to create a new window?" But it was my last day. I literally didn't give a fuck because I was like, I got a PE offer. Bye. Anyway. Anyways, that's unrelated. Hopefully your MDs don't yell at you, by the way. That I would say my investment bank experience is large. You can not have to deal with that kind of thing. But okay. Sorry, where was I going here? Oh yeah, so we've done the average interest thing. Sorry about that. It was like it took forever. And yeah, so okay, now getting to the point of this, what is happening now with the PIK? Well, as you know, the PIK we're not paying, right? So it's going to accrue into the debt balance. Oh, sorry, Alex, to answer your question, it's Alt WN to new window. So like I create as many windows as I want. I like to have two windows. I don't know, maybe it's confusing for you guys. Maybe I should not do that right now, but
well, no, it's extremely useful because now you can edit all your inputs on another window.
Exactly.
Flipping back and forth like an idiot. Like I'm shocked. I never learned this, man. You never taught me this.
Oh shit. Well, hey, learn something every day. Okay. All right. So yeah. Anyway, so the Mez. And you'd be surprised the stuff I'm learning every day. Like sometimes I'm like, wow, how do I not know that? But anyways, PIK. Yeah, it accrues, right? So it's just going to increase the balance. So therefore, interest is going to increase as well, right? So it's like, hopefully, you never had a credit card that you never paid, but it's kind of like that, right? It's like it's just less sketchy because it's like, oh, we're a private equity firm, we know what we're doing, so the banks are like, okay, we trust you. That's why they kind of let them do it. Okay, so now we've done the debt schedule. How do we link that to the three statements, right? Because that's one step, woohoo, but we're not done yet. Because I purposely deleted interest expense. So let's link it in. Okay, let's link it in. Which by the way, it was I'm not gonna lie, when I deleted this stuff, I was like, Josh, I hope you know what you're doing because we'll see if it works. Sorry. So interest expense. So this should be the cash. Very important, right? Do not, or sorry, no, not the cash. It should be the total. My apologies. Because income statement means we want like the total expense. So boom, it's gonna fill in there. I have no idea if the balance sheet is gonna balance after this. I don't know if I regret this already. I may just embarrass myself. But let's keep going. Okay, PIK interest. I'm gonna zoom in a bit because it's a little smaller. Okay, let's add in the PIK. So here's the thing, right? Yes, the PIK is in the income statement, but it's non-cash, right? So anytime you have a non-cash item in the income statement, you add it back in the cash flow statement. And of course, make that positive. So reverse the sign, boom, the PIK interest is in there. What else do we have to link in? Well, this whole section of the cash flow statement is empty. So let's make it not empty. And how do we do that? We go to the debt schedule. You can see how important the debt schedule is right now to this model. Basically makes it work. So gonna go like, basically I'm gonna go equals sum of the borrowings and repayments. So I'm gonna do that for every single one, which shouldn't take too long, hopefully. So I'm gonna just do that again for term loan. So what are we paying? What are we borrowing? we're actually not really boring anything because this is a very simple case study where you're not like doing anything crazy. You're not buying like weird add-ons and stuff. You're, trying to reinvent the wheel.
The amortization too.
Yeah, exactly. And then so then Mez is whatever.
Oh, never mind.
Mez is just gonna be 0 anyway, but because you can't actually repay Mez anyway. But okay, so that makes sense. Yeah, so as you can see, we pay down the revolver, then we pay down the term loan, and of course we have to add the mandatory amortization. How could we forget that? And if I was like, why? Okay, yes, 25. Sometimes it's a funny story, right? I've had 10 million times where I'm like presenting a model to a client or whatever, and it's like not right when I play around with it. I'm just like, oh my God, did I do it wrong? Did I do it wrong? And then I just press F9 like 5 times and it works. Literally press F9 5 times if you're like freaking out. Just do it. Just trust me. It might save your skin. Okay. Excel actually takes a lot of memory. It's funny. You wouldn't think it does, but it's quite computer heavy. Okay, sorry. I'm wasting time here. We have like not that much time left. Let's get to the results because we have linked the statements. Actually, I haven't checked if the balance sheet bounces yet. Not yet because I took a wait. Does it? Ugh. See, guys, that you see if you build it right and you screw around with it and you unscrew it and it still bounces, then you're happy. And this is why I build checks, by the way. At the top of every model I build, always, I have IR and check. I usually have MOC here too. I don't know why I didn't put that, but I always have this thing. I just add everything, and this thing has to equal 0 or else I cry. And it equals 0, so I'm not crying, which is good. Okay, I also do this check, right? If you can go from EBITDA to cash available for financing activities and just like, whatever items that come in between. So they might be interest, cash interest, tax, CapEx. But if you can get to the same number, that means your stuff is right. Okay, nobody can hate. Like it's working. Okay, cool. Let's jump into the Excel waterfall. I mean, they can hate if your assumptions suck or whatever, but they can't. At least it works. Okay, so we're exiting it 9 times. Great. What does this actually mean, right? Because people are like, okay, don't you just like take the EBITDA 9 times, like that's it, right? No, well, it's a bit more than that, because we have options. If there were no options, it'd be very simple, because then we'd just pretty much get to enterprise value, take out the debt, add whatever cash we have, you get to equity value, right? Classic enterprise value equation, and then you'd be like, oh, what percentage of that do we own? Okay, we know the IRR now because we can just take that number and calculate IRR. Except we gave the management 5% options. This is extremely common PE because you have no idea how important management is, right? Like PE people don't know what the heck any business is. Like I go over like, oh, I'll help you buy this HVAC business. I don't know how to run an HVAC business. If that CEO leaves, we're screwed. Like we could hire another CEO, but like for 6 months, you're screwed. So that is why we give them options. Number 1, to keep them. But number 2, also, they need to be incentivized to perform. Like, hey, man, we got to double the value of this company. Let's go. We got to triple the value of this company. So we gave them 5% of the upside. So what does that actually mean? 5% options. Well, this is what it means. If we think about let's say a share is worth $1 million, hypothetically. Therefore, if you go back to source and uses, right, sponsor put in 711 million, management put in 79 million. Therefore, if a share is worth $1 million, we can say, just hypothetically, the sponsor owns 711 shares, the management owns 79 shares. But we have options, and so the options are going to be in the money, right? What does it in the money mean? Is it worth more than it was before, basically, right? Is the stock price higher than the strike price? And in this case, this quote unquote strike price is the value of the company on day 1 when you buy it. So obviously the company has improved since we bought it. So therefore, it's in the money. I mean, it's always going to be in the money unless your company was a disaster, then it's not in the money, and that is a different problem. But we're going to take the money that was invested, right? The 711 plus 79 times 5%. And this is like, quote unquote, the number of shares that management's going to get, as a result of their hard work. So now we've given the shares, but here's what happens, right? If you do the math, this dilutes everybody, right? We just created 40 new shares. The percentage ownership is going to be a little bit different now. Like sponsor used to own 90%, now they own 86. everything's down a little bit, which is normal, right? You just diluted everything. So in other words, once you find the actual percentage, now you can figure out the actual proceeds that go to the sponsor and management as well. So we're gonna get 86% of the equity value, and the rest is going to go to management, some of it via options. Here's one other thing, by the way, people sometimes forget. Whenever you have options, if you remember treasury stock method, if you've ever done that for DCF, you'll know that, although this is not treasury stock method, by the way, but you'll know that there's cash, right? Because if somebody exercises an option, they still have to pay, right? So we're still going to get cash from management, and specifically we're going to get 40. Where does 40 come from? Right over here, because that is essentially the strike price, quote unquote, right? Is the 40. So this is what they have to pay. But for that 40 that they're going to give us, right? This cash, which is going to, wait, oh my God, there's so many errors in this. Sorry, guys. This is why I do this, to correct errors. Okay. Okay, now it incorporates the cash that we get from management. Okay, so I don't know how I missed that. I'm not that. It doesn't really change that much. It's literally like 40. It's not that big a deal. But anyways, that is why the cash is important. Clearly, because I forgot it as well. All right, so now we can calculate the IRR, right? We're at 5:30, just in time. So my original plan was to do the model, but I was thinking like, actually no, that's gonna be like, for me to explain and do it is like way too hard. So I think this is better actually, just me messing around with it. But first of all, how do you calculate the IRR? Well, you type in the IRR formula and you select. But it's very important. First year needs to be a negative cash outflow. Makes sense. You're buying the company. These, if nothing happens, these need to be zero. Like they just need to be zero. And maybe I should have used a different example as well, where the dividend recap. Actually, I might show you that in the next 2 minutes if you want. If people are tired and they don't care, then you can just tell me, because we kind of covered what we need to cover. But okay, so we calculate the IRR, and we also calculate the multiple capital, which is just like how many times do we return, like ending divided by beginning. 3.5 times, pretty good return. Probably do this deal, assuming it didn't, like, the industry doesn't suck or whatever, no big headwinds. Very important to build a sensitivity table. If you're in an interview, always mention the sensitivity table. Like I showed you the steps. People always forget sensitivity because they're like, oh, whatever, who cares, right? No, you need sensitivity because nobody knows how much you can be buying this for or selling this for. I mean, you might know how you're buying for it, but like, we don't know what's going to happen in 5 years, right? What if you end up selling it for way lower, right? Like 7 times. Like, as you can see, suddenly if you sell for 7 times, it doesn't hit the 20% threshold, right? Which is what people look for in PE. 20% might kill the deal in that case, right? If you actually realize, the market is less attractive in 5 years because the company's grown and matured and has less, not strong growth rates, blah, blah, blah. What about, like, this model is crazy simplistic, right? We just basically said like 10% revenue growth every year. That's never going to happen in real life. Like, it's always going to be a little different. Every year, like, it's usually going to be like maybe 15%, and then steadily going down at like 7%, might be more realistic, or 6%, or whatever. But we can sensitize it. Now, you're probably wondering, how do you actually do the sensitivity table? Like it's easy to talk about it, right? But you're probably like, oh my God, sensitivity table. Oh, how do you do it? Okay, well, it's not too hard actually. I'll walk through this one. I'm gonna kill this for a second. And so, first of all, like, create your little table, right? Like, have exit multiple up here, have your entry multiple down here. Decide the numbers you want to use. Make sure that these are not linked to the model anyway. So notice that this is a hard code, right? I do have this you could also just make these like hard coded numbers, but as long as they're not linked to the model. Okay, that's step one. Step two, and this is assuming you want to sensitize 2 variables, right? Which is very common for entry and exit. Step 2 is find the result, like the thing. IRR is the result, right? So we're gonna put it here in the corner. I actually made the font white. You can see that it's actually there. It's just, I was like, it's like a banker thing, just, make it white. I don't see it. Looks good now. So now I'm just gonna select this. I'm gonna go Alt AWT. Okay, you're probably like, what? Wait, what did you just do? Data, right? Data. What if analysis? Data table. And by the way, I'm gonna send a document with all these shortcuts, so you'll, don't have to worry too much about writing these down. But okay, so row. What is row? Exit multiple. Boom. Okay, exit multiple right here. Entry multiple. Boom. Right. because it says column, right? When it's column, it's mean like up and down. What's happening up and down, which is confusing, right? Because I was confused at first when I learned this, but when they say column, they really mean like here, like rows, like what is this variable? I guess it makes sense. I don't know why that confused me. You're probably wondering like, hey, Josh, that doesn't look right. That looks wrong. Well, that's because I didn't press F9. Okay, see, I'm telling you, F9 is so important. F9 is gonna be your best friend. Okay, it'll make you like not cry at times. Okay, so when you think everything's wrong, what about when you're sensitizing one thing? Okay, so once again, select the thing that you want. So IRR, make it white, and then but this time, you put it like not in the corner, but like beside the row, right? And just have the one variable up here. I'm gonna kill this. Boom. Same thing. Alt AWT. This time, I just care about the row. There is no columns. It's just revenue growth. Now you're probably wondering, well, how the heck do I sensitize revenue growth? Like, what is Josh actually doing here? Well, I don't know why I keep referring to myself in third person, but what I'm doing is, you can see that the actual assumption is, wait, hold on, sorry, before I mess around with this, I got to figure out how my revenue actually is growing. Okay, B44 is what it is. Okay, so I found the magic number here. I think it's B44, and then I'm just gonna sorry. Okay, so yeah, so okay, that's pretty easy actually. So I'm just gonna Alt AWT. Sorry, I was overthinking this. B44. The reason I was overthinking it was because there's another way to do this, right? So the way I did it is pretty straightforward. I just like selected. The other way is to like, if you want to do like, let's say, like you want to say like increase in EBITDA margin, for example, or like increase in revenue growth rather than the actual growth itself. You can do that. All you gotta do is just go for your revenue growth. Sorry, I'm going over time now. Did people have to go anywhere? Like, I don't know. I have this tendency to like just talk about stuff that doesn't matter at times, but but anyways, you can just build a sensitivity table, a sensitivity box here. You just make this 0, build a box around that. And what you do is you go like this equals 10% plus this guy. What does this do? This means that you can use this as the variable you're sensitizing now. So if you say like 1%, right, and you put 1% here, that makes this turn into 11%. So it's just a different way to do it if you want to like display the table in a different way. But there's different ways to do the sensitivity table, but they're very important. In addition to revenue growth, you want to sensitize leverage. I didn't do that. Definitely leverage. You want to sensitize definitely like margin, like gross margin. So like cost of goods sold as a percent of sales, basically. Maybe I don't. You probably don't have to. If SGA is not a big deal, whatever, it's fine. But maybe that. But sometimes like capex, if it's a big deal, but especially add-on acquisitions. If your model is driven by acquisitions, you're gonna need that. And this one doesn't have any. That might be for another time. But I feel like that's probably gonna go above your. Like I don't want to give you guys too much at once. Okay, so I feel like this is a pretty good walkthrough. What was I gonna think about showing you but didn't show you? I forget now. Oh, dividend recap. Before I do that though, first of all, I'll take a step back. How are we doing, guys? Should we just call it? Like, I don't know. People are like tired now. Like, do you guys care about the recap? Like, you don't have to care about the recap. It doesn't really matter if you don't. Sorry, how do I actually like get feedback here? What am I doing here?
Hey, one thing that would be useful, I think, is how can this group go and improve their skills in this, right? They're not going to have Josh next to them talking into their ear all the time, right? How can they go on their own and learn more or improve their skills?
Yes, if other than signing up a session with me, which I highly encourage, but you don't have to. The other way to learn it is just practice. I gave you guys this, right? So you can literally just do this from scratch when you have time. Like keyword when you have time, obviously, but and just give it a shot. Just give it a shot. That's the best way to learn, is doing it from scratch. Like people are like, oh, but don't invest in banking. They give you templates and you just dump. No, the templates are useless because, not useless, sorry, but with LBO modeling, it's so finicky that like you don't want to rely on other people's past work and then suddenly your balance sheet balances because like they put in like some weird number for like deferred finance here. You know what I mean? Like you want to make sure that it works. And the only way to make sure it works is to create it from scratch. I know that's weird, right? Like people are like, why would you create anything from scratch? No, but like for LBO modeling, specifically in private equity, practice from scratch because that's what you do for case studies, and that's actually what you will do in an industry as well, right? You may not complete from scratch, but like you're not like this part, the statements, that's from scratch, right? There'll probably be some parts like the fancy model that I showed you where you wouldn't do from scratch, but practice from scratch. That's the biggest thing I can recommend. And do
Another thing,
public companies. Yeah. Sorry, go ahead.
target companies, at least the ones that I look at, have such shitty financials. Like one target might have things working out of QuickBooks, another one might just, run it on an Excel sheet and not even have a general ledger. So all their line items are different. So a template won't even help you.
Yeah, exactly.
If
Exactly.
you're doing public companies, okay, like you have Cap IQ, it's all standardized. Sure, use a template. But for private equity, when you're looking at puny private companies, templates are actually going to make you spend more time.
Yeah, I agree. And they'll cause errors. And it's just good practice. Like this formula, the first time you do this, you'll be like, oh my God, like what's going on? But like the second time, third, before you know it, you'll be like, yeah, okay, I get it. So just do it until it's like second nature. Um, does anybody else have any questions?
For let's say someone's going into an interview
Yeah.
and they're not at this stage yet where they give you a case to take home, but it's not your standard like walk me through an LBO. It's somewhere in between. It's where they give you a case in person, sitting right across from you. You're supposed to do it on paper.
Yeah.
How do you do that? How do you practice that?
That's a great question. And in fact, I may send this across. It's a paper LBO. By the way, these materials I prefer if you don't spread them all around the world if possible, because I do use them in my sessions quite a bit. But anyways, but feel free to go nuts on them yourself, of course. But okay, so caveat: you're allowed to spread it if you think they're signed up for a session, but that's about it. Okay. Okay, but one thing I will share with you guys is a paper case study, which is very actually probably the first thing to practice. Because you're like, this is probably a little overwhelming. Like, let's be honest. But this is a good. I'll send this over. Right, a paper LBO, very common in entry level PE jobs. Right, so like you're a student applying for PE, you're gonna have to know this for sure. But good to know for IB too, actually, because it helps you understand what RR actually means, how to get to it. So you can see this is so straightforward, right? It's like, yeah, like buy whatever. It's like 50% debt. I didn't even use a multiple. It was just like there are no transaction fees. Like there's no net working capital. CapEx equal to DA. DNA is flat. Like it's really simple. Like all margins constant revenue growth rate. But here's the other thing about paper LBOs. There is no debt schedule because you can't build a debt schedule with a pen and a calculator, like unless you're crazy. But I mean, you could. It just suck. So yeah, it's not debt schedule. So what that means is this is pretty easy to do. Actually, if you're doing this very quickly, right, you can actually take a lot of shortcuts. So you'll see what I did here. I multiplied by 8% revenue. Instead of calculating COGS and SG&A, I know they're constant as percent of sales. I can literally just be like, well, EBITDA margin is going to be constant too then, and just take the EBITDA. And in a paper LBO, they'll be like, hey, that's smart. Good for you. Like in real life, you probably don't want to do that, but in a case study paper LBO where you have like limited time, it's actually smart. DNA is flat right here. And you can see interest expense is flat because we're not paying off debt. There's no debt schedule. The cash just accumulates on our balance sheet. So long story short, we do all this stuff. A lot of this stuff is flat and or like really simple. And what's happening, as you can see, is that when we sell the company, right? We bought it for 150, 50% debt, 10 times EBITDA. But when we sell it, EBITDA is 44 times 10 for 41 minus, 150 debt. But is the 150 debt? There's also cash, right? So another way to look at it is like we've accumulated 39 of cash, which is just basically like me adding all the cash of the future years is just sitting there. And I can use that to pay down the debt, right? Like potentially like the 150 is I can take it down to 111. For some reason I broke it separately here, but whatever, it's the same thing. And so yeah, this cash ends up reducing your debt or basically like increasing your equity value. Therefore, it still like increases your return in the end, right? But of course, in real life, you would use that cash to pay down the debt and reduce your interest expense as well, whereas we didn't get that benefit here. So that's the only difference between the paper LBO and a real LBO. But that might be good practice. What do you think?
Yeah, you should all do this. If you don't have time to do the crazy big one, definitely do this one like multiple times until you get it.
Yeah, do this. And by the way, in case you're curious, we don't in private equity, we don't do like a 3 statement LBO like the first round, by the way. Because you've probably seen the sims I gave you. They're or some of you guys have. They're not a lot of info. And to be fair, in larger PE firms, it's a bit more info, but it's not enough info to build a full balance sheet and all this stuff, right? Sometimes there is, but even if there is, it's just a lot faster to do a short LBO. And if you're doing a short LBO, it looks a bit more like this, right? Notice that I don't have a cash flow statement here. I don't have a balance sheet, right? I'm just taking a shortcut to get to this magic number, cash flow relative financing, because it's technically just free cash flow, right? If you think about it, it's just like, yeah, it's basically like net income, and then you make some adjustments, right? You add back D&A. If you have PIK interest, add that back, right? Less capex, and the increase in working capital, and then bam, there you go. That's it, right? So I would recommend do the paper LBO first, and then try doing a quote unquote short LBO where you're not creating a cash flow statement, you're not creating a balance sheet, you're just going straight to cash flows available for financing. And then of course, you might maybe like for example, if I did this, it might look more like this, right? You might still have a debt schedule. It just might be very simple. By the way, if you're in a rush, uh, you don't feel like typing the formula like I did, you can literally just like eyeball it, right? You'd be like, I see that cash flow. Here's positive, so I'm just gonna like put in their payments. Obviously, that's not the right way to do it. You should actually be doing like, oh, is this thing, lower than or higher than 0 or whatever, right? And whatever. I won't type in the formula here, but you could just create this is a fast way to do it, right? So you could literally like create an LBO in like, I don't know, one tiny little thing here. Does that help?
Yeah, perfect.
Sweet. Any questions, guys? Maybe I won't do the dividend recap thing. Actually, I think it's a little. I feel like gone through a lot today. And you guys can always just ask if you're curious. Any other questions? I still don't know how to. I'm apparently very bad at Microsoft Teams, but any questions? Because I can't see them, so you might have to just voice it. Okay, give you guys 5 seconds. 5, 4. People never have questions, right? Because it's like I teach it so. No, I'm kidding. People usually do have questions. They just don't ask them. Okay, since there are no questions, I will send this paper LBO. Okay, and by the way, Alex, do you know what the deal is with staffing for Patriot? So I've had a number of people interested. I'm just not sure who. I don't know. I can talk to you after. Or
you can pick whoever you want who shows interest.
God, I have to pick.
Or tell them no. I don't care.
Okay, I'll kind of circle up everybody and we'll figure it out. Yeah, but okay, cool guys. Hope this is helpful. And hit me up with any questions and hope.